Okay, we're going to jump into chapter 6. Now, a lot of this we've kind of covered either in earlier chapters to one degree or another, or with our conversations with Bill Gaylord. But I do want to go deep on some things. So we're going to cover some ground we've seen before. So hopefully some of this is starting to sound familiar to you. This is the language of lending. So I want you to be comfortable with our alphabet soup that we need to use. It becomes a point where words like TILA, RESPA, TRID, LE, CD, things like that mean something to us. So again, whether you're in real estate or going into real estate lending, these are all things that you need to feel comfortable with. So you're not going, what do you mean? What's the CD? Why do we have to wait to close? And so and so forth. So why is this not? Okay. Truth in Lending Act, or the TILA. So also known as Reg Z, Regulation Z. Regulation Z covers a lot of things. So, as we've done before, let's look at the history a little bit. Back in 1968, yes, I was alive then, but just a boy. And, the way things were done then was a lot of what we used to call, and it's still a valid term, it's called caveat emptor, buyer beware. Or in the case of lending, borrower beware. So Reg Z came around. Part of what it did is it standardized how we describe interest across the board. In theory, it was designed so we would have an APR, or annual percentage rate, which would be a single number that we could use to compare one loan against another. Well, unfortunately, and when I was in the business, it used to drive me crazy because one lender would calculate with certain parameters and another lender wouldn't. And so there's a lot of fudging going on with that before. So again, the purpose behind that ideally was, hey, if I go to lender A, B, and C, I can say, what's your APR? This is my loan. What's my APR, my APR, my APR 3 times, and you'll have something you can compare. But sometimes they hide the light bill in certain ways that you wouldn't see. Now it's very standardized, and less emphasis is on the APR and more emphasis on the actual, what are the costs to get this loan. So most borrowers now easily can compare one loan one lender, one loan program against another. Reg Z also contains certain provisions that apply to advertising, includes a right of rescission, which is a right to cancel, and has certain triggers. So the triggers, as they talk about, let's see, they don't talk about it here. So let me jump into that here. It's in your book. We talk about the triggers, and this really affects you whether you're in lending or in real estate. If you advertise a property, let's say for sale, recently I had a condo, it was about 600,000. So if I say, hey, buy this condo and your payments will be only 2,500 a month. Okay, that's fine. But what else I have to tell you is, what's the purchase price? What's the loan amount? What's the down payment? What's the interest rate? And I really should tell you whether that's just for the loan itself or the loan and the mortgage and the HOA, et cetera. But that's not really the non-loan things aren't really included. So a lot of times when you see payments quoted, you get really excited. And down at the bottom of the page, there's this teeny tiny print that will tell you all those details to be compliant with Reg Z. However, most people only see the payment. They don't see the payment plus taxes, insurance, and HOA. And they may not really look at the down payment. They may be thinking of putting 10% down, and the minimum down payment's 20% down to get that loan, or 25%. So you have to read that fine print with Reg Z. But just remember, as a lender or as a real estate agent, whenever you quote, low down payment, so if you're affecting the down payment, or the mortgage payment or the interest rate, these are all triggers that will trigger requirement to have more information provided to the public. So again, as I mentioned before truth in lending, deception was the practice as opposed to the exception. Lots of people, so obviously these laws come around when enough people get screwed and they go, wait a second, I just got taken. And so they go to their lawmakers, either state or federal, to correct it. So finally in 1968, Congress passed the Truth in Lending Act, which was a good start. And then later on, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. We just generally call that Dodd-Frank. And it made some changes. It put the TILA and RESPA under the supervision of that Consumer Financial Protection, CFPB, that we've talked about before, this all-powerful CFPB that controls all consumer loans, to say, okay, everybody's got to play by these rules. There are few exceptions to it, but not a lot. So in our world of real estate, primarily with residential real estate, it's covered under the Dodd-Frank bill. So under the TILA, the creditor, the person or the company that's making the loan, is responsible to be in compliance with this act. So they can't just go, oh, I didn't know, and make you the loan. No, that's a requirement of their license, of their role in the transaction. They describe who was defined as a creditor. And sometimes as a mortgage broker, you might be able to do things outside of this whole TILA world if you meet certain requirements. I'm not going to go into the weeds there. They talk about it in the book a little bit. You can read up on it. Again, that's the exception, not the rule. We're going to live in the 80% of the business that you'll actually be doing. So if you get in that other 20%, dive back in the book, check with your broker, make sure that you're covering all bases. Certain transactions are exempt. Business loans are exempt. Credit over a certain dollar amount, unless it's towards someone's principal residence or personal property use. So if you're buying a motorhome for fun, it's exempt. If you're buying a motorhome to live in because that's going to be your new home, it's not exempt. So the lenders involved with that, again, it's their responsibility to meet the legal requirements. So now let's talk about RESPA, Real Estate Settlement Procedures Act. Now this has been around for a while. It started in 1974, and it had quite a few laws to it, but those laws didn't always get enforced. So it took some time for some of the enforcement to catch up. But what it did is it normalized the process for closing a transaction throughout the United States. And this was very beneficial to our mortgage industry, because now the same documents would be used in Florida as they are in California. So an investor could buy Florida mortgages or California trust deeds, and they would know by looking at these standardized practices for closing practices were being met. Now, something very important is RESPA forbids kickbacks or the use of required title companies, or limits the amount of funds required to be deposited into escrow accounts. So let's break those three down. First, let's talk about kickbacks. So anytime you're getting or giving a referral fee and it's not to another licensed real estate broker, that could be construed a kickback if any form of federal loan is involved. So generally speaking, unless it's completely a cash deal, do not even think about giving a kickback to anybody who's not involved with it. So kickback also goes two ways. Please don't go to your escrow officer or your title officer or title rep and say, hey, I gave you 5 deals last month. I think you owe me a little something, and be expected a piece of that pie. They can't do that under RESPA. You don't want them to do it under RESPA, because a violation against them is a violation against you, and you could lose your ticket. and have fines and possible jail time, et cetera. There was a title officer I knew of, and he had an escrow division, and what the escrow division would do is they would give the brokers $100 kickback for sending escrow business to them. Okay, direct violation, but the way they would hide that, they never put it on the closing statement of here's a kickback. They would charge the borrower or buyer $100 for a messenger fee. And you know what that messenger fee was? To drive the $100 check over to the broker. So he got caught. He ended up with jail time. And as I've said before, I really don't want to go to jail. I don't want to go to prison, but I don't know that I really don't want to go to jail or prison saying, yeah, I gave someone $100 when I shouldn't have. I don't think you're going to have a lot of street cred off of that. So RESPA also, okay, so we talked about kickbacks, the use of required title companies. So we as the broker cannot say you have to use this title company. The seller can say, hey, I've got a title order open. I want to go through this title company because they understand what I need to do to close this. So in a perfect world, it would be fairly negotiated back and forth between title and escrow. In Northern California, escrow and title tend to be the same company. Not the case in Southern California. I'm not sure how it's handled in other states. But in reality, so let's talk reality as opposed to letter of the law. In reality, what happens is whoever typically is the stronger agent, they're the one that's going to get it. And it really depends on, is this a seller's market or a buyer's market, and who's the stronger agent? That's usually how it gets handled in the negotiations. Before I go to the last part of that, I want to mention something called affiliated business relationship disclosures. So for instance, I work for Keller Williams of La Jolla. Keller Williams owns a company called Own Mortgage, OWN Mortgage, and they also own an escrow company, Cal Coast Mortgage, which is a broker. It's technically a corporate escrow, but the principal who owns KW also owns a piece of that company. Therefore, he's going to profit as a shareholder of that company, which is totally legit, provided that each agent in a transaction discloses it to all parties so that they know that this relationship exists. And if you go to Coldwell Banker has their affiliated business relationships, and other companies do too. So, again, nothing wrong with it, provided that all parties are made aware of it and agree to it. So then the last part about this is the amount of funds required to be deposited into escrow accounts. So we use the term escrow in a couple ways here. One is an escrow company that we do the transaction with. The other is what we call the impound accounts, or many lenders call it the escrow account. So when a lender puts together an escrow account or an impound account, they are typically with banking a portion of the next payment for taxes and insurance. And they have a really clear calculation based on, your insurance is going to be easy because it's fresh at the time of close. Taxes get a little more difficult because of our weird tax year process that we have, but it's easy for them to calculate how much they will need to hold back on each payment, so that when each of those bills come due, they'll have more than enough money to pay in sufficient time. Now, once a year, they have to true up that account. And sometimes they're $20 high, sometimes they're $100 low, whatever that is. So if they're high, they're going to send you a check to bring that amount down. If they're low, then they're going to increase your payment for the subsequent year to accommodate that. And it's very common for that to happen. You go, well, why is my loan payment going up? Typically, it's taxes and insurance. Your insurance payments may go up. They always have for me. And taxes are predictably going to go up 2% a year in California. So each year they analyze that, and each year they have to make some kind of adjustment. If you have a shortage in your escrow account, they will typically say you can either send us $67, or we're going to raise your payment by $5.50 a month, or whatever the math works out to be. So again, they're not going to borrow from their own money to make your tax or insurance payment. They want you to have enough money in there. RESPA dealt with these problems by requiring all. Well, that's it. There we go. RESPA protects consumers from predatory lending practices. So, yeah, there's a lot of opportunities out there, and we've talked about it in other chapters. That there's a lot of things that could or did go wrong in lending, called predatory lending. So RESPA is responsible for correcting that. RESPA has also dealt with these problems by requiring all lenders provide these disclosures to the borrower. One is a HUD booklet. Whenever somebody buys or borrows, there may be terms they're not familiar with. So they send a standardized booklet that says, this is what an adjustable rate loan is. This is what a margin is. This is what an index is. All those things. So it's a little textbook for the borrower. They're going to get a good faith estimate of all settlement charges to say, hey, this is what it's the charges that we anticipate. And they're going to get a uniform settlement statement prior to close of escrow. We used to call that a HUD-1. Now it's generated by the lender. It's a closing statement, but basically it's still in the HUD-1 format. So let's talk about TRID. So again, new language came out in 2008 with Dodd-Frank. One was TRID, the TILA RESPA Integrated Disclosure Rule. So I'm glad they didn't call it TRIDR or something like that. So these two things at the top are really the most important. I don't know if you can see my no, you can't see. Yeah, there's my mouse. So loan estimate form and closing disclosure form. So the LE, the loan estimate form, within 3 days of application, the lender will say, okay, here is your LE. And usually this is done like right after your offer is accepted. You know which escrow company you're going to use, you know which title company you're going to use, because the lender has to go in and get all these expenses, and we'll go through a chunk of them here in a moment, and give you a very clear estimate of those things. And then 3 days prior to closing, because you have a 3-day right of rescission, when you get this CD, this closing disclosure form, to say, here are your charges, and they have to be within a certain margin of error from what the lender originally told you. So gone are the days that the lender can arbitrarily jack up the cost of your loan to say, hey, yeah, but your credit's not as good as we thought it was, so it's going to be a little bit higher, or whatever other excuse they could use to jack up your loan. And of course, you're sitting there with a U-Haul filled, and you want to sign this thing off, and you just agree to it. Well, not anymore. Now the lender has to have that comply within this margin. So again, borrowers are given the loan estimate form within 3 days. 3 days prior to closing, the borrower gets a CD or closing disclosure form. The borrower should compare that, make sure it's apples and apples, not apples and oranges. And then if there is a big difference, so let's say that they promise you 5% interest, and then now it's 5.25% interest, and the lender says, oh yeah, well, remember we such and such, whatever that is. So whenever the loan changes, I can't say that the lender changes it, but whenever the loan changes, then they have to reissue the loan estimate form, and you have within 3 days of that change. Now, if it's the closing disclosure form, now the borrower has 3 business days. The lender has 3 business days to provide it to the borrower. And then when the borrower has that, they may have up to 3 days to agree or not agree to it. So we've seen this before when we get close to a closing and there's something wrong on the CD, and now we have an additional 3-day delay. because that may mean having to redraw the documents and meeting this legal requirement of 3 days. So keep that in mind when you're thinking flexibility with your clients, whether you're working with sellers, buyers, or helping them get a loan. 4 individual disclosures are required under TILA and RESPA, and now that they've been under TRID, there are 2. What I already explained: the loan estimate and the closing disclosure. So gone are the other formats that we used to use. And then, as mandated by Dodd-Frank, effective 2015, the CFPB published TRID, combining the disclosure. So we had a period of time there from the 2008 meltdown till the Dodd-Frank bill before it was enacted. And I'll tell you, back in 2015, it was a slog trying to get up to speed with these new terms, and of course, whenever something like that happens, and Bill Gaylord and I talk about it a little bit, is that, we thought, oh no, we can never close another loan. This is too onerous. We can't do this. But yeah, we figured it out. So TRIDs don't apply to HELOCs, home equity lines of credit, reverse mortgages, or loans secured by mobile home. So let's go deeper into this loan estimate form here. So this is what it looks like. This is what you're going to get within 3 days. It says it identifies when it was issued, who it was issued to, what the property is, and what the sales price is. The loan term, the purpose is a purchase or refi, product fixed rate, adjustable, what loan type, conventional, FHA, VA, or other. It might be a reverse mortgage share, for instance. What loan ideas are we putting with this? And is there a rate lock? So let's talk about rate lock for a moment. When you're shopping for a loan, you're going to get a lot of rates, but until it's locked, you don't know what rate you have. And if you lock a loan and you have 60 or 90 days before you're closing escrow, the cost to get that rate lock is more than the cost to get a rate lock for 30 days. And the reason is simply risk. The lender's taking a risk that you will actually close this, and that the market won't shift too much, because again, if they lock you in at 5% and the market moves to 6%, that loan is not very saleable. But behind the scenes, they protect themselves through a series of safeguards to make sure that they'll have that money available at that interest rate. But you do want to know whether or not something's locked. I used to say the old real estate lender's prayer is, "Dear Lord, let there be one more rate drop, and I promise I won't float." Because when it's not locked, it's what they call floating. When you're in an environment where rates are going downwards, sometimes it's prudent to not lock. However, in today's market and for the foreseeable future, I think you're going to want to have locks. Now, this is, September 2022 that I'm making this video, and in 2023, that might change completely. We could have had a strong recession, and the Fed says, hey, we have to stimulate the economy and lower the cost of borrowing, and it could go down. We don't know, so I don't want to predict. So we're going to identify the loan amount, the interest rate. Again, we told you it's fixed rate here. How much is the monthly principal and interest? That's just to repay the loan at this interest rate. They also ask, does this loan have these features, prepayment penalties or balloon? This loan does. So what's a prepayment penalty? If you pay it off early in the first 2 years, it could be as high as $3,240. Why do lenders charge prepayment penalties? Well, one might say because they can. Another might say, well, you might get an artificially low rate, and they are banking that in case interest rates go down, they don't want you refinancing this in the next 2 years, because the cost to get you that loan has not been recovered unless they get to have this loan for 2 years. If they don't get to have this loan on their books for 2 years, then they're going to lose money. And so this, because they gave you such a beneficial rate. However, if you keep it more than the 2 years, it'll all come out in the wash for them. So some people might say, why would you get a loan with a prepayment penalty? We used to laughingly call it a prepayment privilege. And I'll give you an example of my own. There was one situation, I was going to get a loan that was a lower interest rate than I already had. And I knew that for the next 2 years, I was not going to do anything with it. So I got a better interest rate when I committed to that interest rate and said, okay, I'll take my chances if I have to pay this off, but I ain't going to pay this off. Therefore, I got the lower interest rate for the whole 30 years, as opposed to a slightly higher interest rate for that full 30 years. So they gave you the projected payments here. You can see in this case, there's a mortgage insurance, and I'm sure we'll talk about mortgage insurance in another class, but just real quickly, mortgage insurance is designed to protect the lender, not the borrower, in case the borrower stops making payments. Okay. And then after 7 years, it drops off. In some cases, you can get it to drop earlier. You have to look at your note and see what the provisions are for that. But you have to kind of prove that the market value has come up, or that you've made enough payments to lower the loan to value ratio to where this is an 80% or lower loan to value ratio. So something to keep in mind there. Estimated taxes and insurance, they just, they do their calculation. Will it be impounded in escrow? Yes, will be. It gives you, how much do I think you need to, how much are your closing costs going to be? And we'll look at them in a moment as far as taxes, insurance, those are recurring closing costs, and then escrow, title, lender fees, and other things. So it will be there. The reason these two numbers don't agree is that you're also going to have an additional down payment, which we'll see in the next slide. So in this closing details, so here's some of the lender fees. 1/4 point loan amount is a standard origination fee. Most lenders, I think, charge a point for origination. Again, it really depends on the market, and they have to be standardized about what they charge. An application fee, $300, that's to cover their cost of taking and starting this loan, and an underwriting fee. These generally we we'll call them lender garbage fees or junk fees. Not that they are, but that's, this is an area where lenders would really fill this up with a lot of different fees just to try and soak the borrower for more money. This is a great part of this closing cost estimate because you get to see what they really are charging. So they break it up into services you can and cannot shop for. You can't shop for appraisal fee. That's standardized. They have to go to a service, and that service is what you're going to pay. That's also a fee you're going to pay up front, by the way, if you're the buyer. Credit report fee is usually charged at the end, but again, they have their own service they go to. You can't just say, hey, I want to go to Credit Karma and use that instead. Flood determination fee, they always have to check for that. As far as a flood monitoring fee, what happens if this changes and it does go into a flood zone. Tax monitoring fee, which is an interesting thing. Well, they put a service on there to confirm that once a year, or maybe twice a year, this service will go in and compare and make sure that your taxes have been paid. Now, in one case, you might go, well, what the heck? I've got an impound account. The lender should know that. You don't have to keep that impound account unless you have FHA or VA. But on a conventional loan, you don't have to keep that. So you might have it in year 1 and get rid of it in year 2. Well, that lender can't then go and say, well, then you need this tax monitoring fee. No, they just charge that to you up front, whether you have impounds or not. the lender knows that they're going to be safeguarded and that they will know if the taxes haven't been paid. Because remember, taxes are a higher priority on the property than the loan. So if the taxes foreclose, they're going to wipe out this loan. So they need to be protected. Tax status research fee. I think that's just something that they do to find out what the taxes can or will be. Seems like a pretty high number to me, but I'm sure some company out there, that's what they do for a living, and that's they pass that on to you. Okay, services you can shop for: pest inspection fee. You know, if the seller hasn't already done that, and that's what you want to do as your inspection, you're going to do that. The survey fee, we don't do a lot of those in San Diego. Insurance binder, if you get one for title, there's a specialized program, specialized policy they have called a binder policy. So if you're going to buy a property to fix and flip, let's say, you're going to want to get a binder policy that says, hey, don't issue me the policy yet. I want to be able to assign this policy to somebody else, and they charge you a fee for it. In most cases, you're not going to see a binder fee charged unless you're working with a fix and flipper. And then again, that's probably going to be an all cash deal in most cases. Settlement agent. Okay, lender's title policy, borrower typically pays that. Settlement agent fee, that's the escrow fee. And the title search, that's a fee that in Southern California is typically paid by the seller. But again, this will reflect what your actual transaction will be. And that's the responsibility of the lender to get that information. Taxes and other government fees, mostly recording fees. Sometimes there's transfer taxes. They're usually paid by the seller. Prepaids, these are your insurance premiums, prepaid interest, and taxes. So when you close a loan, loans are always paid in arrears. So when you close a loan, you what you're doing is, so if we close escrow on October 1st, well, there's no payment due until November 1st. Well, let's say we're going to close on September 15th. So we want to have this start 30 days out. So September 15th to October 15th, let's say, is 15 days. We use a 30-day calendar regardless of the month. And so we prepay that 15 days. That starts you fresh at October 1st. Then your first payment is until November 1st for the money you borrowed during October. So there will always be, unless you happen to close at the end of the month, some level of prepaid interest that they will collect, along with the homeowner's insurance for not the fee itself, but the anticipated fee for next year, and the property taxes based on where they are in the tax cycle. Owner's title policy, optional, typically in San Diego, Southern California, the seller pays for that. Anyway, they add this all up and they give you what's the total closing costs. Down payment from the borrower is $18,000. You already put $10,000 down when you wrote the contract, so that means there's another $8,000 due. So it'll come to a total of $16,054 that you're going to have to bring into escrow in order to close this. They get in some other information about it. How much will you have paid in principal, interest, and mortgage payments in 5 years, and how much principal is paid off through that? What's your APR based on the cost of getting this loan? Your total interest, what percentage are you paying in interest compared to the total amount of loan that you borrowed over the entire course of the year? So it's not 69.45% annualized, it's total. So they get into some details about other considerations, and then the borrower signs off on this. Now, when we go to closing disclosure form, guess what? It should look exactly or very close to what we had before. So I'm not going to chew through each of these, but the dollar amounts might change if the situation has changed. This is what the closing cost looks like. And this is closer to the what we used to call a HUD 1 that will break down and identify is it paid at closing or before closing. Again, appraisal fee is typically paid in advance. And just breaks all these down to where you've got a dollar amount that you have to come in with, and then provides a summary of the transaction as well, how much the seller will be getting out of the transaction, and details as far as, can this loan be assumed? Is there a demand feature? How much are you charged for late fee? Does this include negative amortization, which we'll talk about in another chapter? Can you make partial payments? Let's say your monthly payment's $1,000, that you don't have 1,000. Can I send in 500? Would that be accepted or not? Lets you know that your house is being used as security interest. And for now, on your loan, that you have an escrow account, which again is the same as an impound account, not the same as the escrow company. They get in the gory details of total payments, finance charged, amount financed, APR, and so forth. And all the key things about, who is involved in this transaction, who the settlement agent is, and so forth, but definitely who the bank is. This is what's given to you, again, 3 days before closing escrow, and it should jive within a certain range with the original loan estimate. So again, as a lender, I'm going to say as a loan officer, you're not going to deal with this a lot. If you go to work for a lender, what I call behind the scenes, as a loan processor, a loan underwriter in the closing department, you're going to deal with this a lot more. Plus, when these documents go out to be signed, they typically go to escrow. Escrow is responsible for explaining this to the borrower, or a lot of times they'll have a notary service that specializes in this. I've had lots of students working on getting their notary license so they can do loan signups. It's a fairly lucrative business. But you have to be able to quickly describe each of these if the borrower has a question. So anyway, hope you got something out of that, and good luck with the quiz.